Hi, I talk often about the need for globally diversifying your portfolio and not holding everything in India. And often I get this question that if India is among the fastest growing economies in the world, why not invest only in India? So let me tell you the story about some other fastest growing economies in the world, which I'm sure not many people remember because this is about 25 years ago. So 25 years ago, there were all these Southeast Asian countries which were called the Asian Tigers: Taiwan, Korea, Thailand, Philippines, all of them. And then there came a time around, as I said, 25 years ago, when something called the Asian crisis happened. And in one year, in one single year, in dollar terms, the stock markets of those countries went down between 50 to 90%. So Taiwan went down 50%, Indonesia went down 90%, and all the other countries were between 50 and 90. So an investor who was investing only in Indonesia was down 90% in the matter of one single year. And that for me personally was a wake-up call, and that was why at first Global globalized and became the first Asian member of the London Stock Exchange, and then the NASD in 99 and 2000. But that's another story. The point is that even very fast growing economies can have a crisis, but let alone a crisis. Suppose there's no crisis even. When I started working, the US dollar was 12 rupees. Now you know it is 80 plus. So there's been 85% depreciation in the value of a rupee in the course of less than a single career. So when you're talking of long-term planning, long-term goals, and often some of you yourself or your children want to study abroad or spend time abroad, maybe some people want to retire and spend part of the time abroad, you cannot have all your wealth tied up to a single currency. And also remember that Indian equity markets are roughly between 3 and 4% of the world equity market. So there's no reason to put 100% of your money there. Every economy, the investors have a home country bias where they put a disproportionate money into their own country, but to put 90% or 100% is too much. It is too much risk on a single economy, which is still relatively small in global terms. Also remember that global diversification doesn't mean that you go and buy a Nasdaq ETF and ho gayi global diversification. That's not how it works, because at different times different countries do well, different asset classes do well. So that's the other thing to keep in mind. So it has to be a portfolio that is diversified, that recalibrated tactically at least a few times a year. So that is the reason. In fact, this is a cause for me, because I think, Indians have far too little that is invested outside India compared to what should be prudent management of your assets. And that is why we have a truly diversified global product, all geographies, all asset classes, which normally you will not get for less than $1 million. Our starting is at $10,000, because as I said, even though it's a hassle to manage in some senses, but this is something I want to give to Indian investors, that even with $10,000, with a little over 8 lakh rupees, you can have a truly diversified global portfolio. And now the liberalized remittance scheme, the LRS of RBI, is fairly generous. So you can send $250,000 out per person per year. So family of 4, that's $1 million. That's over 8 crore rupees. So, well above what most people will need to send out. So do keep in mind why you need global diversification and start taking the first steps right away. That would be my advice.